How you own your real estate matters just as much as what you buy. Structure it wrong and you could lose thousands, or worse, expose yourself to legal risk you never saw coming. Whether you're buying your first rental or scaling into multiple properties, choosing between owning in your personal name or through a corporation or an LLC if you're in the US is one of the most important decisions you're ever going to make. I've seen people lose their principal residence exemption, get hit with capital gains they didn't expect, or get caught in legal nightmares because they didn't plan ahead. So today, let's unpack everything you need to know before you make the mistake of buying first and asking questions later. When I was first starting out, I remember a conversation with an investor who owned a triplex under their personal name. They had done it all themselves, no accountant, no legal advice, because they wanted to save money. Fast forward a few years and they were deep in a lawsuit with a tenant. The liability, it wasn't limited to the property, it came for their personal assets too. And that's when it really hit me. Structure matters. This isn't something you want to wing after you've already bought your property. Now, I want to have a disclaimer here. Before we get into today's episode, please remember, this content is based on my personal experience as an investor and property manager here in Canada. It's not intended as legal or financial advice, so whatever I say here, take it as really good FYI information and then consult with your licensed lawyer or your accountant in your region before making any structured or tax decisions. With that said, let's get to the main body of the show. Should you incorporate your rental property? This is one of, if you look on the internet, it's probably one of the most common questions asked by novice investors. So let's try to understand the basics here. Personal name versus corporation in Canada or an LLC in the US. In Canada, you can own property either personally or through a corporation, typically a standard Canadian controlled private corporation. In the US, most small to mid-size investors use LLCs, which stands for limited liability companies, because they're pass-through tax treatment and liability protection. Now, in personal ownership in both countries, US and Canada, it's simpler and cheaper, but less protected. So what are those key differences? Well, corporations in Canada do not offer pass-through taxation like LLCs in the US. An LLC lets profits and losses pass through to your personal tax return with no double taxation. Canadian corporations are taxed on rental income at passive rates unless the income is active business income. What does passive rates mean? Basically, a passive business would be like an actual investment like a stock, taxed at the very highest level, rather than corporation of an active business could be 10% versus 49%, just as an example. Capital gains treatment is also very different depending on structure, but again, speak to your accountant. So I think question number 2 here is, will a corporation or an LLC actually save you money on taxes? And the answer, not definitive, maybe, but only under the right conditions. So you want to ask, is your business active? Do you have 5 or more employees? That's the rule here in Canada. Are you flipping homes or offering real estate services? Those are all things of active businesses. Flipping homes, that's an active business, active inventory, okay? Or are you just holding these rental properties with yourself and maybe your spouse? That's passive income. Do you plan to reinvest profits, or will you need to pull out income personally each year? Can your corporation qualify for small business deductions? Okay, again, usually only on active income, but check your jurisdiction, speak to your accountant. Another question, are there tax deferral benefits to keeping money in the corp, the LLC, versus taking it out as salary or dividends? Now, in Canada, passive income is taxed heavily inside a corp. Again, I mentioned that 50% or more, and only after tax refunds can it become viable. In the US, LLCs allow a little bit more flexibility. Okay, number 3, what are the costs and complexity? Now, this has to do with corporations and LLCs because they do come with higher complexity and cost. So you want to ask your lawyer, how much does it cost to incorporate and maintain it annually? You have legal filings, corporate returns, bookkeeping. Will you need separate bank accounts, insurance policies, financing structures? Is your accountant familiar with real estate inside corporations or LLCs? Are you willing to pay more to gain protection and scalability? I mean, with accounting, I know a personal return might be hundreds of dollars and a corporate return might be thousands of dollars. So if you only own one rental property in your personal name that counts towards your personal income, you're probably only going to pay a few $100s. If you have that single property in a corporation, you have to decide whether it's worth it to pay the $2,000 or $3,000 or whatever it's going to be for that corporate financial return in exchange for that privacy, the tax structures, the tax benefits. Okay. Another tip here, I think, is a lot of new Canadian investors are very surprised to learn that even the rental schedules for personal ownership are much easier and cheaper to file than T2 corporate returns. Okay. So again, my advice is if you have a rental property, just get an accountant. Don't try to do it yourself. I believe that paying the money to the accountant is going to save you in the long run, either through, better expenses or at the worst case, saving you from an audit. Now, the biggest question, this is number 4, what about lawsuits and liability protection? Because I think that's really where corporations and LLCs shine. So you want to ask your lawyer, what's at risk if a tenant sues you for injury or dispute? Okay. Are they going to sue you personally? Are they going to sue the corporation? Are you exempt because you happen to own that corporation? And I want to say it depends. I have heard of cases where, depending on what the infraction is, it exposes the directors of that corporation to lawsuit. So then it's kind of like, what's the point of having that corporation? Okay. Could your personal bank accounts, home, your stocks, your RSPs be exposed? Does your current insurance policy cover legal claims fully? Okay. Really, really good question. Would you feel safer knowing that only your corporation is liable? I think I would, but again, positives, negatives, what is your long-term goal as an investor? How big do you want to get? Is it only going to be the one and done? Are you planning on scaling it to multifamily? Are you going to be having one apartment block and one corporate LLC like a lot of large investors do? Okay. And that brings me to my next point. Owning a property, in a corp or an LLC can protect your personal assets, but you're still going to need proper insurance and governance. You don't want to treat a corporation like a magical shield. Okay. You're going to have to know what you can and what you can't hide behind, where you're exposed. Number 5, will you be house hacking or living in the property? Because personal use matters for tax reasons, especially in Canada. So you want to ask, do you live in the property, like a duplex, a triplex, maybe a basement suite? Do you plan on claiming the personal residence exemption? Because if a corporation owns the property, you could lose that tax exemption. So you want to ask your accountant that. Can you partially allocate personal versus investment use? Kind of depends. Canada Revenue Agency rules are pretty clear on this. You can't claim principal residence exemptions if a corporation owns the property, even if you live there. Again, that's at the time of this recording. And like I said at the beginning, do your research. This is just for informational purposes only. Number 6, do you want to scale and bring in partners? Okay, if you do, then 100% corporate structure makes scaling easier. So you want to ask yourself, do you plan to raise capital, do joint ventures with other investors? Would you benefit from issuing shares to investors or partners? Do you want the ability to sell your shares rather than the property if you want to get out? If you don't like your partners, if you need to liquidate, rather than selling the entire property, if it's in a corp, you can just sell your shares to another investor, to your other partners, and it's a lot easier to get out. Okay. Are you building a long-term portfolio or just trying it out? Okay. So that's where I'm always saying, know your long-term goals and then reverse engineer how to get there. Incorporating early can help if you know you want to build a team, access business credit, or exit later without triggering capital gains immediately. Number 7, what's your exit plan? Corporations can offer more flexibility for selling or succession. So you want to ask, do you plan to sell the property or pass it down to family? Would share sales be more tax efficient than selling those assets? Do you want to retain value inside the corp and defer personal tax? Is it easier to sell a company than an individual property in your province or state? And when you say sell a company, you might have a corporation that owns 5 properties. You're selling a company as opposed to, hey, I'm selling these 5 properties that I own in my personal name. So planning your exit from day one will often inform you how you should structure your entry. Again, what's the goal? Reverse engineer how to get there. Now, if you haven't already, Check out my earlier episode where I go deep into building your real estate dream team. I talked about how to find a great real estate lawyer, accountant, mortgage broker, property manager, but pay particular attention to what you should look for in a good real estate lawyer. Okay, so I encourage you to go back a couple episodes and listen to that, because a good real estate lawyer is a vital part of making sure your corporation, liability protection, and tax structure work together seamlessly, as well as your real estate accountant. So in summary, there's no perfect structure, but there's a right structure for you. Personal ownership is easy and accessible. Corporations and LLCs offer scalability, protection, and control, but come at a cost. Whether you're house hacking, growing a portfolio, or planning to flip 5 houses a year, take the time to align your strategy with your structure. And whatever you do, don't buy the property first and figure it out later. Still unsure which path is right for you? Download our free 7-step guide to buying your first rental property. It covers ownership structures, key professionals you need, and common mistakes to avoid. Just click the link in the show notes and it will send the guide straight to your inbox.